I started a stock portfolio that cracked $100,000 in less than 3 years, and I'm about to show you how I did this from scratch to prove it's not luck. Just last month, I had a total of $3,000 hit my account. That's money I did not work for. It's money my investments worked for. Before we begin, it's important that you know this is all due to 3 simple investing strategies that you can use to go out and get way better returns than the S&P 500, even if you have no prior experience investing. I've spent the last 9 years researching companies that have consistently returned 50% plus average returns that you don't have to. And yes, this will work for you even if you've never invested a single cent before, or you are just starting out and can only invest less than $500. Because when you know how the smartest people invest, you'll be able to copy them and finally have your money start compounding over time, until you get to the point where you have complete financial freedom to spend more time with your family, quit your job, or even enjoy the finer things in life. So I'm about to show you exactly how I started this new portfolio from scratch so you can copy me and grow your portfolio. Let's dive in. You see, getting these 10% monthly returns isn't just about picking the right stocks. It's about having the right tools for the job. Imagine trying to build a house with a rusty hammer and a bent screwdriver. You're setting yourself up for failure. That's what it's like trying to invest with a bad broker. I'm about to reveal the key features you need to look for in a broker that will actually help you make money. Now, before we get into the nitty-gritty, let's talk about why selecting the right broker is crucial. Think of your broker as your partner in crime. You wouldn't want to rob a bank with just anyone, right? Okay, maybe that's not the best analogy, but you get me. Your broker will help you execute trades, manage your investment accounts, and provide resources and support. If you choose the wrong one, it can really blow up in your face. It's like trying to bake a cake without flour. It just doesn't work. I have a personal relationship with my broker and account manager who helps me navigate the market. This level of support in a really competitive environment is a game changer. With the right broker by your side, you can achieve your goals within months instead of years. Okay, so you're fired up and ready to find a broker that will propel your investments to the next level. But here's the thing, not all brokers are created equal. There's a whole world of difference hidden beneath the surface of flashy ads out here. Taking the time to thoroughly research a broker can make all the difference in your investment journey. It's the key to unlocking those consistent 10, 20, or 30% average returns and achieving financial freedom faster. Let's break it down. There are basically 2 types of brokers. The first is full service brokers. They offer personalized advice, portfolio management, and a whole lot of hand-holding, but they come with higher fees. If you're someone who wants a roadmap for your financial journey and you don't mind paying for it, this could be a solid option because everything is done for you. The second is discount brokers. They're like that friend who gives you the go for it push but doesn't hold your hand, and for that you pay lower fees and you do everything yourself. Which one works for you? Well, that depends on how much you want to control your investments. You need to ask some critical questions of the brokers that you're interested in, and don't just take the broker's word for it. Check out independent review sites like Trustpilot and see what other investors are saying. Pay attention to both the positive and negative feedback and you can make a decision. Finding the right broker is just one piece of the puzzle. It's like having a fast car, but you still need a map to guide you to the right direction. That's where your investment philosophy comes in. It's the compass that directs your investment decisions, ensuring you stay on track towards your financial goals. Over 90% of the people I've worked with never take the time to define their investment philosophy. They just drift along and chase the latest trends. But you're here, so that means you're not like most people, and you'll be organized and have a portfolio that looks like this, and you'll be able to make money like this. Now let's talk about the fun part, allocating your capital. This is where it gets juicy. Now I know the whole process can seem like a little daunting maze of numbers and formulas, but don't sweat it, I've got you covered. I've been there, and I wish someone told me these 3 tips when I was starting out. Tip number 1, keep a diversified portfolio. What does that mean? Well, it means not putting all your eggs in one basket. You don't want to be that person holding only airline stocks when a global pandemic hits. Tip number 2, find an allocation principle that works for you. There are 3 main principles that you can use. The first is equal weighting, which means you can allocate an equal amount of money to each investment regardless of a company's size or sector. The key benefit here is that this can provide more exposure to smaller companies with higher growth potential. And the second is risk-based allocation, which allows you to allocate your money based on the risk tolerance that you have. An example would be allocating a higher percentage in lower risk assets like dividend stocks if you're more risk averse. The third is value-based allocation, which requires putting in more money in companies that you believe are undervalued by the market and based on your own research and analysis. And tip number 3 is aiming to split your investments across different sectors like tech, healthcare, and maybe a little bit in renewable energy. That way, if one sector flops, your entire portfolio doesn't nosedive with it. If all that's too complex, don't worry. There's a strategy to start investing and remain invested, which is as simple as boiling water. And the best thing about it is you can automate it and remove yourself from the task. And this is dollar cost averaging. Sounds fancy, right? Well, basically it just means investing a fixed amount of money at regular intervals instead of all at once. So instead of buying $500 worth of GameStop all in one day, I might buy $100 worth every week. The main benefit of this strategy is that it helps you smooth out the price fluctuations and can lead to a better average cost over the long term. So whether the stock's price is rising or falling, you're not panicking. panicking. You're just averaging it out. It's a chill method that takes the stress out of trying to time the market perfectly, because let's face it, you're not Gandalf. It's important that you also remember that even the most carefully crafted investment strategies can be derailed by unexpected events. Market crashes, recessions, global pandemics. These are the storms that can test the resilience of any portfolio. So why should you even care about these market hiccups? Well, let's be real. When the market goes down, it can feel like a punch in the gut. But here's the kicker. Knowing how to safeguard your investments can not only ease that pain, but also help you come out on top when the dust settles. I've been through my fair share of market downturns, and today I'm sharing my 5 top tips to help you protect your hard-earned cash. So grab your coffee and let's get into it. Tip number 1, diversify, diversify, diversify. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes. Go ahead and even invest in other instruments like bonds, real estate, maybe even some crypto if you're feeling a little bit adventurous. This way, when one part of the market tanks, the others can help cushion the blow. Seriously, if you don't have a diverse portfolio yet, it's time to get on that train. Think of it like a balanced diet. If you only eat burgers, which I love by the way, you're gonna miss out on essential nutrients. Tip number 2 is setting stop loss orders. Now, for all you tech savvy folks out there, a stop loss order is like your safety net. A stop loss means just that, stop my loss. It automatically sells your stocks once you hit a certain price. This way, you can limit potential losses without having to watch the market 24/7. Setting these is super easy, and most brokers provide this feature because it adds that extra layer of security during those wild market swings. Tip number 3, keep some cash on hand. This one might sound boring, but hear me out. Having liquidity means you can buy the dip when everyone else is panicking. Those sweet discounts on stocks? Yes, please. It's like being at a garage sale. When everyone's freaking out and selling their antiques, you swoop in and bag the best deals. Just don't go overboard. You still want your portfolio to grow. Tip number 4, focus on quality companies. Look, I know it's tempting to chase after the next hot stock, but this is your portfolio we're talking about. Stick to quality companies with strong fundamentals, solid management, and a track record of weathering storms. These are the companies that can survive downturns and often thrive when the market rebounds. Think of them as a reliable friend that sticks by you when times get tough. You want the ones that stand the test of time. Tip number 5, keep your emotions in check. Okay, let's get real. When the market has a meltdown, fear and panic can take over, but that's when cool heads prevail. Having a game plan in place so that you're not making impulsive decisions based on emotions helps you step back, assess, and remember investing is a marathon, not a sprint. Mindfulness can really help you stay focused in the long game. So there you have it, my top 5 tips on how to protect your portfolio when the market decides to throw a tantrum. The final step addresses an unknown danger newbies have no idea exists until it starts to erode their returns and increases risk. It's like a slow leak in a tire. You might not notice it at first, but eventually it can lead to a puncture. This threat happens gradually and causes some of your investments to outperform others, which might look like a good thing, but over time, it comes around to bite your This hidden danger is known as portfolio drift. To explain portfolio drift, imagine you're baking a cake. You carefully follow the recipe, adding the exact amount of flour, sugar, and eggs. But as you're mixing, you accidentally spill some flour and add a little extra sugar. Your cake might still turn out okay, but it won't be exactly what you intended. That's kind of what happens with portfolio drift. You start with a plan, a specific mix of investments like tech stocks, healthcare stocks, and energy stocks designed to match your goals and how much risk you're comfortable with. But over time, some investments grow faster than others. Maybe your tech stocks shoot up while your healthcare stocks plod along. Now your mix is off. You have more tech than you planned and less of healthcare. To mitigate this, you use a technique known as portfolio rebalancing. First things first, what is portfolio rebalancing? If you're anything like me, when you start investing, you probably pick a variety of stocks. Some tech, some healthcare, maybe even a bit of cannabis for those risky vibes. But over time, these stocks can drift away from your ideal mix. So why should we even bother? We're making good money, right? That's a good question. Life's full of surprises. Just look at COVID. Rebalancing helps you manage risk because a portfolio that sails smoothly at 70% tech stocks and 30% healthcare might now be 90% tech after a tech boom. So when that market turn happens, you're in deep waters. So how do you know when to rebalance? This is how I do it. I set a calendar event every 6 months or so, and if I see my asset allocation sway more than 5 to 10% from my target, that's a signal. Think about it as a biannual health checkup for your portfolio to make sure it's in peak shape like LeBron James. Now let's break it down step by step. Here's how you can do it. Assess your current allocation and check which assets are currently in your portfolio and their percentages. Number 2, you want to compare your goals. What's your ideal mix? For example, 60% tech stocks, 40% cannabis stocks. Number 3, you want to calculate variances by figuring out how much you've strayed from the ideal. And then number 4 is decide when to buy or sell. And this might mean selling some high performing stocks to buy some low performing stocks. And number 5, execute the plan. Hit that buy or sell button, and not gonna lie, that's the best part. The key lies in understanding the different rebalancing strategies, their pros and cons, and how to tailor them to your specific needs and risk tolerance. By the way, there are some super handy tools out there to help you with this. Mobile apps like Robinhood Robinhood or Webull provide insights into a portfolio's performance and make rebalancing super easy. Plus, some robo-advisors do it automatically so you can never have to worry about missing the day to rebalance. In summary, rebalancing is just not some pesky chore. It actually is very essential to keep your portfolio healthy and your investment strategy on track. Remember, the key is to be disciplined and consistent. Rebalancing helps you maintain your desired risk profile, capitalize on buying opportunities, and stay on track towards your financial goals. So take the time to learn different approaches. Choose the one that aligns with your needs and execute. And with this, I've just handed you the exact blueprint that helped me start my portfolio from $0 to $100,000 within 3 years. But here's the truth. Knowing this information is only half the battle. What separates successful investors from everyone else is having a solid game plan and actually sticking to it. That's exactly why I created something special for you. Remember everything we covered today? Choosing a broker that treats you like royalty, capital deployment that keeps you in the game forever, and portfolio rebalancing that no longer makes you a sitting duck in the market. I've packed all those and more into a complete investing course that's yours completely for free. No catches, no upsells, just pure value. But I'm also throwing in something even better inside this course. You'll find my investment philosophy that you can use to make yours, the 3 most successful stocks in my portfolio, and tips and tricks to get you started building a winning portfolio in 60 days. Here's the thing though, we're still making this course, and the good news is you can sign up for early access. You'll get notified when it's ready, which will be around January of 2025. So click the link in the description, enter your email, and we'll send it over to you as soon as it's done. If you like this video, leave a like and don't forget to subscribe. Thanks for watching and have a great day.